Hey everyone, welcome back to InvestStream. I'm Pankaj, and today we've got Arjun Arora, former partner at 500 Startups, the founder of ReTargeter, also ran BD at Yahoo Real Estate a long time ago. Arjun, thank you so much for joining us today.
Great, thanks so much for having me, Pankaj. Really appreciate it.
Yeah, Arjun, we spent a little bit of time together, working together at 500, and we've seen a whole bunch of different things evolve, not just in the ecosystem, but at 500 and globally as well.
Mm-hmm.
And, we've seen a massive explosion of microfunds over the last couple of years. So, thanks a lot for coming on and sharing some of your thoughts on how somebody else can get started in raising their fund. I want to start a little bit with your background. And if you could just tell us a little bit about, how you got to where you are today with Valence Advisory and,
Sure.
Kind of all the different pieces that kind of brought you to this point.
Yeah, absolutely. Yeah, I'll give you a bit of the quick linear story. So I grew up down in Southern California. I went to school at UC Berkeley, studied electrical engineering and computer science. So had a pretty technical background and was fortunate to understand some of the nuances of what it takes to build product. From there, a couple of years at Yahoo, early days of Yahoo Real Estate, just as things were moving online, from offline newspapers, bus backs, magazines to listings online. So that was a great experience of helping to see or helping to move the industry from offline to online. I then started my first company, which you mentioned, ReTargeter, in the online advertising space. That got to some meaningful scale. We were fortunate to have customers all over the world, ranging in size from local smaller startups all the way to Fortune 100 companies. We sold the company in 2015, and then bit of a long, circuitous path, but eventually became a partner at 500 Startups. I had been investing and advising personally for quite a while prior to that, and so and was close to the 500 crew. Was an LP in Fund One, so it was a nice logical transition to be there. Eventually at 500, I ended up leading our efforts globally for fundraising and investor relations for the firm. So that put me in a lot of really interesting rooms in front of LPs from all over the world, as well as helping some of our microfunds think through their strategies and fundraising approaches as they went out and raised capital.
Wow, that intro doesn't give it justice, right? There's like so much there to unpack. Maybe we're going to do another episode and just talk about that. Specifically, the retargeter journey. I think that's an interesting topic because a lot of founders have opportunity to sell their companies, but don't necessarily know how to go through the process and how to handle that. Before we jump into starting your own fund, I'd love to just hear what that story was like. What the process looked like for you.
Absolutely. I think our acquisition story is one of these kind of very sharp examples of how a buyer ends up being somebody that you built a relationship with and partnered with for a long period of time. So interestingly enough, we ran a very kind of standard and concerted acquisition process and M&A process in which we reached out to 100 folks that we had known over the years as we were getting ready to sell the company. But at the end of the day, the kind of 3 or 4 folks that remained in that process where we were able to start getting some conversations going and some negotiations going, a couple of those we had known for quite a while, and one of them we had actually partnered with, and there was kind of a strong business development relationship. And that entity ended up being the one that acquired us. So I think, my advice to founders and CEOs would be start building those sort of business development, corporate development relationships early, and really start to get to know a handful of teams that could either be either a distribution channel or a product partner or some other sort of partner. And oftentimes those eventually will turn into deals, and or they will end up being a great entity in the process to help with the negotiations, to help drive up the price if all goes well. So I think that was kind of our biggest lesson from that experience.
Okay. How long did the whole process take?
It was a good 6 months, maybe even a little longer. So it definitely, from end to end, and that wasn't including the kind of final closing process, which was probably another, 3 months on top of that. So I'd say all in all, it was probably a 9-month process.
Wow. All right. Well, we'll talk about that in more detail later. But I will jump into the topic of today, which is how folks can get started with raising their first fund. How how do people evaluate whether it's the right thing for them and whether it's the right time for them to go out and raise a fund? Really, it's two separate questions. So let's start with, is it the right thing for an individual? How do you figure out whether it's the right thing for you to go out and raise a fund?
Yeah. I think it's such an important question, because a lot of folks jump into it and saying, oh, this is the cool, hot new thing to do. Let me just go raise a fund. I've done a little bit of angel investing. And this is cool. And I think what's really important is to understand, the big why behind why you're looking to start a fund. And I think the critical question there is understanding, am I incredibly passionate about finding great opportunities, investing in those founders and those companies, supporting them, and then ultimately also helping them get to an exit. And I think in service of your LPs. So that really has to be a kind of deeply underlying reason. Any of those things, but ultimately it is about creating returns for your limited partners and finding those companies which are going to be successful. There's 1,000 different reasons to do it in addition to that, but I think at the foundational level, that really has to be ultimately what drives you. And I think that's an important question to ask. Yeah.
Can we unpack that a little bit specifically before moving on to the right timing? For a lot of folks, especially folks that might have worked at a fund before, or even folks that haven't worked at a fund but have been active angel investors, the whole process of working with LPs and managing LPs is somewhat new for a lot of folks, right? And so for a lot of people, I think the question might be, well, how do you handle the beginning of the fundraising process in terms of LP expectations and what else is happening, right? Like, somebody else could be on fund 15 and, they might be talking to the same LP that you're talking to. As a first-time manager, like, what do you do? How do you handle that?
Yeah, I think one of the most important things to get right out the gate is to understand what your sharp thesis or perspective is on the world, and really, really explicate clearly what you see in the outside world and how you or your team is best suited to go after that particular opportunity. So first-time funds get backed by even institutional investors if they have an incredibly sharp thesis and a team that is aligned to that thesis. And so I think it's a kind of GP-Thesis-fit, to borrow a metaphor from some other folks. But I think that is a really critical component. And if LPs see that you see something in the world very crisply and are able to go and kind of capture that opportunity, then they're going to be interested to have a conversation, whether you're, a first-time fund or on fund 15. And frankly, some fund 7, funds 8 kind of lose that alignment, and maybe they have some scope creep or something else happens. So, as a fund, even if you're further down, you still have to maintain that tightness of thesis GP fit and alignment with what's kind of going on in the market. So I think that's critical regardless of what fund number you're on, but certainly much more important in kind of earlier funds or funds 1 and 2.
Yeah, that's great. Let's jump into timing now. Like, we've figured out some of these initial things. Maybe you haven't really figured out your thesis yet, but you've started scratching together what will eventually become a thesis. How do I know it's the right time, right? Right now. Is
right,
this
sure.
time for somebody to go out and raise fund 1, right?
Yeah. Well, I think in some ways, it's always a good time and it's never a good time. And I think that's, incredibly explicated by the reality that we're in today. But I think because venture is a 10-year game, because you're really committing to, writing checks, at least initially, probably over a 2 to 3 year period, and then, managing and staying close with those investments over a full 10-year period and seeing them through to exit, you're really committing for a decade. And if you're truly building a platform versus just a one-off fund, you're probably committing for 20 to 30 years. So any given sharp moment in time is, less important. It's more about the grit and your desire to kind of see your thesis out in the world or support kind of what you see and invest in companies that fit that thesis. So I think, in some ways, I'd say if you're looking to build a platform, which is, my preference or our preference in terms of who we, like to work with and engage with, then the timing in some ways really doesn't matter. It's about what energy and effort you're putting forward in the service of that larger goal. So if it's a little crazy time and there's a lot of volatility, then maybe you're spending more time on research, maybe you're spending more time meeting companies, maybe you're spending more time supporting your portfolio. But if the market turns and there's general excitement, then you want to really lean in hard and work towards that first close or final close as appropriate.
Gotcha. Okay. As VCs, and angel investors, we look at a founding team very carefully. We try to spend a lot of time understanding what skills the founding team has. Are they complementary? What's their relationship like? And of course, then can these guys really execute on what their startup vision is? But from a fund perspective, it's a little bit different, but in many ways also very similar. Right? How do LPs evaluate a fund team, and how important is it for LPs in general? And specifically, what things are important for LPs?
Yeah, I'd say it's absolutely critical. And of course, a startup is a people driven business, but that's even more true in a venture fund, because you're not necessarily building a product that can eventually, go on and scale without that initial team. The team really is the product in many ways. And so I think the necessity to have a sharp kind of culture for that team and have a clear set of values that are explicated, and also a very clear kind of compensation structure. See a lot of times, funds have challenges with either younger GPs or folks who, feel like the economics aren't necessarily appropriate or equal. And that's where you see a lot of split off funds, or you see other kind of challenges occur. So I think first and foremost, one, it's really important. Two, having a clear set of explicated and aligned values for all members of the team, and then making sure that ties into the compensation or the economics of the fund are absolutely, critical. And I think, earlier in my kind of venture and / LP exploration, I was sometimes shocked by what one might consider basic the LP questions around team dynamics were. I've heard institutional investors ask GPs, tell me about a time you failed at something. Tell me about a time you had success. What did you learn from it? It seems like something that might be, question you would ask a junior employee who's just coming out of college. But the reality is that those questions inform LPs with so much rich context on who those GPs are, what they stand for, and how their inter-GP dynamics work. That even those basic questions can share so much data.
That's great insight. Never would have guessed. Tell me about something that you failed at. It is a question that institutional LPs, are going to ask a GP. But all right, so you talked about in one of your blog posts about auditing you, right? And this is kind of an important step in figuring out what am I going to do first, right? Once I've made that decision.
Yeah.
Tell us a little about this concept of auditing you within the emerging GP framework.
Yeah. So I think the important part about auditing you is really understanding deeply and having a as close to reality as possible awareness around kind of what are your individual strengths, how do you work with other people well, how might you get triggered or not work with other people well, what is your specific experience and expertise, and what does that bring to the table? Also, what are your passions and interests? What do you care about outside of just the purity of investing in startups? And then one of my favorites is just deeply understanding your networks and kind of relationship mapping, so that you have a very clear sense of where you have a depth of network connectivity, where you're connected to nodes and super nodes in the ecosystem. So you can really map the flow of entrepreneurs, LPs, and other things that might arise from some of the kind of network connectivity you have. And so I think being just very, frankly, blunt and real and with yourself around, what am I good at? Who do I work well with? Who do I truly know and understand? And what pipelines of kind of connectivity do I have? And being sharp on that, I think, is really critical. So it's often helpful to have other people for lack of a better term, you could do kind of a 360 review, ask people you've worked with, ask other folks you've invested in or invested with, and try and just get a sharp sense of that, because that will really help you define that clear thesis and then help show LPs why you are best served to to go after that particular approach or that thesis. Can't hear you.
Can you hear me?
I can hear you now. Mm-hmm.
So once a GP has gone through some of these exercises, they've evaluated themselves, they've started putting together a thesis, they have the beginnings of what could be the GP team.
Mm-hmm.
What's the absolute first thing that they should really start working on?
Yeah, I think the just to kind of dot the I's and cross the T's, I think the absolute first thing is to get a team of great fund lawyers, some great back office support, to really make sure that you're covering that side of the house, and then get your LPA together, your limited partner agreement, so that you've got the paperwork, you've got the deck, you've kind of structured a blurb, a short kind of email that distills what your fund is about, so that it's easy for folks to share. And then, I think you get started. Yeah.
Okay. So let's roll it back a little bit to the deck and kind of putting those blurbs together, right?
Yeah.
I know startup founders in many instances spend weeks, if not months, working the deck, having other founders review it, having some friends or angels review it and give suggestions, and continuously iterate on it after each meeting that they're doing. And in some cases, sending, I tell founders that you should really have a customized deck for specific founders, right? For specific investors, not necessarily using one generic deck being the best idea. When it comes to raising a fund, right? Let's talk about that a little bit. Like, putting the actual deck together, which is, really taking your thesis and your team and distilling it down into, whatever, 5, 10, 15, 20 slides.
Right.
What does that process look like, or what should it look like?
Yeah. I think just like when you're raising capital for a startup, it is a very critical and important kind of aspect of raising money and just frankly of a company's history. And I think it also requires the requisite amount of iterations to get really crisp and really tight, and to have people help you, with that fund thesis. In some ways, I'd say it's even, more important when doing this for a fund. But what I would say is critical is getting that overarching narrative tight. And I think for that, it's, it might start as simple as a simple Google Doc, and you just kind of write, right through those kind of key points and then start to pop it into a deck. But what you want to get crisp is obviously the team, the core thesis, where you see the market going, in particular in the area that you're interested in, your track record, and why, what you've invested in the past. Of course, is, past performance is no indicator of future success, but I think it's a really helpful way for LPs to understand, more practically what some of your thinking is and what some of your networks for connectivity are, and how early or late you like to get involved and to what degree you like to get involved. So it's a way to physically kind of manifest some of the things that you've shared before in your thesis or in your team. And I think getting that all distilled into the blurb from there is kind of the next important step. Yeah. I like to go kind of wide first and really kind of get rich context, and then do the hard work of making something that's actually simple. And I think, as the old adage goes, I didn't have time, so I wrote you a long letter. I think that's very applicable here as well.
Yeah. In terms of advisors, when do you start engaging advisors, right? Like, should you start getting some of these folks involved when you're starting to start really wide and start narrowing down, or should you bring certain people in later? What are your thoughts on engaging trusted advisors? Yeah. Who might some of these advisors be? How do you evaluate, right? And for startups, you might have somebody who's a really great advisor at a certain point in time, But
Mhm.
as the startup progresses, they may not really be as relevant anymore, right? So how do you take some of these things in context of a GP and raising a fund, or eventually moving past fund 1 to fund 2 and fund 3,
Yeah.
and existing advisors that were there in the beginning? Let's talk about that a little bit.
Yeah. So, I think the reality of advisors for a venture fund is that there are folks that can be tactically and practically helpful either to your fund from a narrative and an LP perspective, or to your portfolio, or frankly, sometimes are just social signaling to kind of showcase that the networks that you claim to have access to, you are connected to the super nodes in those ecosystems. And that's kind of a touch point or a proof point to say that, hey, I'm claiming that I'm connected into X community. And here is someone from X community that is very well respected, and that clearly is a supernode in that community. So sometimes it's just valuable, for that perspective. And sometimes it's having folks that can help with distribution. So I think these days, more than any other time in the past, we're seeing celebrities kind of involved either as advisors, or in some cases, frankly, even GPs, just as a mechanism to show, that there is the distribution and access that comes in through that person having having some skin in the game. So I think there's all kinds of different advisors that can be helpful, and I think part of your role as a GP is to build out, the best advisory network that you can to help you win deals, be supportive to your companies, help you kind of connect with and close the largest LPs. So it really is a two-sided marketplace. You're getting LP money, and then you're deploying it into startups. So having a well-rounded advisory board that can help you with all sides of that equation.
So when you're getting started and you're really starting to think about who some of these folks might be, who would you recommend might be like the first 2-3 people that you reach out to, right? Like, is it somebody that you've co-invested with in the past, and it could be somewhat of a mentor or advisor to you? Could it be somebody who you invested in, who's now had a nice exit, and that might be an advisor? Like, what does that person look like?
I'd say the filter that I would recommend is probably more around trust. I think somebody that you deeply trust, that is aligned with your values and understands, your networks, and or gives you access to new networks that you might not have, is, I think, a critical component of building that out. And I think it starts as kind of concentric circles. So folks that you're close with, that you really trust, that understand you deeply and understand what you're trying to do in the world. And then from there, you can kind of, build out. And so, funny story from my brother's experience, just to explicate this kind of example, is he started a company out of UC Berkeley. His first news article was in the Daily Cal, the kind of local newspaper for UC Berkeley, and then eventually he parlayed that into a larger article in kind of the city newspaper, and then eventually was on the front page of the Wall Street Journal. So I think the kind of ability to start close and then continue to build out from there, and bring more and more interesting and relevant and helpful people onto your platform over time, is the right way to do it. But I think initially you definitely want to go with folks with whom you have a strong working relationship, so you can move forward quickly.
Okay, makes sense. Many first-time founders struggle to get meetings with VCs, right? They may not have the network to tap into. They might be relying on Twitter or Facebook for messages.
Yeah.
Similarly, many emerging managers don't have a large LP network within institutional investors, or family offices, or high net worth individuals. So how should emerging managers go about kind of solving that cold start problem?
Yeah. I think it actually, interestingly enough, comes back to the answer I gave before, and that I think through LinkedIn, AngelList, Crunchbase, these days there is so much data out there on folks that you're connected to, one, so starting there, and then two, understanding their second and third degree networks, and using that as a mechanism to start to get access to these folks who write checks. And so I think, fortunately, there's been a lot of great folks out in the ecosystem. Samir Kaji from First Republic comes to mind, the folks at SVB. There's a handful of people who've gone out and kind of published some of this information around who some of these emerging manager investors are, who are these LPs that like to invest in this space. And I think another tactic that might be helpful is looking for, on Crunchbase and looking at series, C, D, E, F rounds. And when you start to see family offices and other kind of institutional investors come in, they're typically co-investors or they're typically part of SPVs where they're getting access to these later stage deals. Not always, but sometimes those folks are also writing checks directly into funds. So their risk appetite is a little different. They're not comfortable writing seed and Series A or even Series B checks, but they're more comfortable writing pre-IPO checks. That risk profile is also sometimes similar to the same risk profile that will invest in funds as a way to get access to this asset class. So that's another mechanism by which to start to discover folks that might be interested in investing in early funds. But I think, there is a tremendous amount of data and information out there. And then this kind of goes back to one of my earlier points is like truly, as you're doing your audit, deeply understand your network connectivity, who you're connected to, who are they connected to, so that you can start to map out, how you might have the warmest introduction to one of these LPs to present your story.
So, what are some of the motivations for some of these LPs to invest in a really early stage fund if they are more interested in writing direct checks at a pre-IPO stage, right?
Yep.
So there's a long gap between an early stage fund and writing a pre-IPO check. So, how do you make that pitch to some of those family offices or institutional LPs that are used to writing those late stage SPV checks?
Yeah, and sometimes it's actually building a relationship with those LPs through showing them SPV opportunities. So, a couple of friends, one in particular comes to mind, that basically built their fund for 3 or 4 years, just working on very interesting SPVs and sharing them with a series of LPs, eventually building enough trust and excitement and interest for them to say, hey, wow, you've been sending us great deals for 3 or 4 years. We've seen some meaningful success, markups, exits. We'd love to just back you from the beginning so we don't have to deal with the back and forth of getting an SPV and being under a tight timeline. We just rather give you the money and know that you're going to do a great job with it. And this really speaks to the realities of being in the venture game as a 20, 30, 40-year exercise. And so if you're going to be in the business for 30, 40 years, spending the first 3 years to get some great SPVs out in the market and build relationships with LPs, if you truly are coming from a cold start problem, is worth it because you're committed to the asset class, so to speak.
Yeah, that's great advice. One of the challenges that a lot of founders have is around building those relationships, right? The amount of time that's involved. And that's something that we tell founders also is like, hey, start building relationships with VCs. Whoa, sorry about that.
No worries.
Yeah, really high winds picking up here.
Oh wow!
Sounded like something crashed against the house. So building those relationships takes a lot of time, and you might be building a relationship, like you said, for years before it goes anywhere significant. In terms of GPs, the process of raising a fund in many ways is more difficult than raising a round for founders, right? Definitely. So the amount of time that you need to commit to building those relationships also needs to be filtered, right? Like, where do you spend that time? How do you spend that time? What are some of the things that you do besides for, if you don't necessarily have good SPV opportunities in front of you right now, what are some of the other things that emerging managers can do to start building that relationship and start building that trust for years, right?
Yeah, absolutely. So I think, particularly as a fund 1 or fund 2, your mix of LPs is predominantly going to be, high net worth individuals, family offices, maybe some corporates, at best. But there you're going to start to build relationships with those particular entities. But at the same time, if you're truly looking to build a platform, you want to start building relationships with the institutional investors for whom you might need to know them for 3, 4, 5 years before they would even invest. There is an entity in Europe that invests the money of a particular royal family that says we don't invest in GPs until we've known them for 10 years. And that is their stance, right? So for those folks, they can be great LPs. They can write checks across 3, 4, 5 funds, but you're going to need to start to get to know them early. And so for any of those institutional investors, the ability to kind of keep them on a cadence of updates that showcase, again, your thesis and how you're operating in the ecosystem against that is critical. So it might just be, hey, we're looking at these companies, we invested in these companies. If you can't invest, we advised. If you're not advising, you might be running SPVs. So whatever you're doing to engage in the ecosystem against your thesis, and sharing not only the tactical kind of investments that you've taken, but also market insights. What are you learning? How can they know that by having a relationship with you, they're going to get a proprietary insight into the ecosystem that they couldn't get from elsewhere? What are they going to learn by reading your emails or staying in touch that they might not learn elsewhere? So that, I think, is an important part of the relationship building and the cadence of updates and communication that are required to build and maintain and eventually close an institutional investor.
So a lot of this, it sounds like, is really not that different from what founders have to do, right? Like, founders are encouraged to send regular updates to not just their investors, but to other stakeholders. And it sounds like, GPs have to do a lot of the same stuff. Yeah. In your experience, how many GPs are actually doing this well?
Mm-hmm. I'd say, the ones that have raised institutional capital are legally obligated to do it, so they have to do it well. So I'd say in the emerging manager, kind of asset class or in the earlier stage there, I'd say some, most are doing it well. I think there's a few that, might just be doing one kind of opportunistic fund or tacking it on to a company or corporate or, some other agency that they might have that are not necessarily doing it well because they're not necessarily in it to build a long-term platform. But I think if your desire is to build a, generational or multi-generational platform where you eventually will have someone succeed you, then this is an absolute requirement. There's kind of no way around it. And the ones that don't do it, even the Sequoias and Excels of the world are still sending an LP report.
Yeah. Mm-hmm. So beyond just doing your mandated quarterly reporting and stuff, what are some other things that you can do to kind of help build this trust with folks that aren't necessarily LPs yet, right? As part of the relationship building. A lot of LPs, like you said, will say, hey, I know I'm going to get certain information from you that's going to help me. So, all right, here's my ante to get in the game. What about those folks who said, well, we're going to wait for 10 years to get to know you? Right. So what do we do for 10 years to build that relationship, but at the same time not make LPs who paid the price to get in feel like, what, they didn't need to?
So I think some of that is around, having, so LP kind of annual meetings is one great place to express this. And these days, of course, maybe they're virtual, but the story is still the same. And you might have a section where you invite prospective LPs or you invite folks that, aren't yet kind of inside the tent, so to speak. And there you might share some higher level insights and you might, show a presentation from one or two of your founders. But for those who are, inside the tent, who have actually committed to the fund, they get access to a much richer set of insights and information and direct access to SPVs and follow-on opportunities that someone outside may not get. And so, for some of one of the things we haven't chatted about, which I think is critical just purely from a structural and financial perspective, is how do you set up the right co-invest and SPV opportunities for your LPs? And how do you rank order who gets access to what? And I think what I've seen work well is kind of pro rata, first come, first serve sort of approaches to invest in your best companies as they scale, if you're a seed or Series A fund, into B, C's, and D's, and get access to deploy more meaningful capital at a lower risk profile, because there's kind of strong information that exists from the GPs and from those who invested early and know the founders and the team and the market really well. So that's another structural way to ensure so that those LPs who have a fiduciary duty to grow their respective pools of capital know that they're only going to get access to those later stage opportunities if they are actually LPs, and their order from which they get access to those opportunities is going to be driven by their level of commitment to the fund.
Mm-hmm. Gotcha. Great point. We got a question here that I think would be interesting is, what are some of the LP VC dynamics that founders should be aware of, or at least try to understand?
Right. No, it's a great question. So I think one of the most important things to understand is that VCs really have to be making investments that can potentially return the fund, right? They have a certain risk profile. The LPs are investing in the venture asset class because they believe that this is an asset class where they can hold their money for 10 years and are going to see a meaningful and outsized return than putting it in a liquid, pool that they might be able to pull more quickly. So to be very explicit about that, I mean, ideally they're looking for 20, 30, even 40% net IRR, for their investment. And that means that they have to have funds that are returning a meaningful amount of capital in orders of, multiples of the money that they invested. So, they're really looking for that 3, 4, 5 X funds, ideally even more, and to get lucky every once in a while with maybe a 10X fund if they're investing at the seed stage. So that's their expectations. But in order for a VC to be able to produce those sort of results, they need to have a meaningful amount of ownership in a company that sees hyper growth and a very significant exit. So that means that when you are pitching a VC as a founder, it's important to understand that those are the dynamics, those are the metrics and KPIs that they're being held to as VCs. So how do you present your opportunity, and how are you actually an opportunity, more importantly, that can get to that level of scale and growth so that the fund can potentially return its entire fund with just one investment?
It brings up not necessarily a related question to the overall topic, but it's still an interesting question, is from an LP's perspective, not necessarily from a fund perspective, but from an LP perspective, what is considered to be a meaningful amount of ownership, right? Like, we know funds that will write 50K checks for 5%. And then we know accelerator programs that write $1.5 million check for a variable amount of equity.
Sure.
So the truth is probably somewhere in the middle, right? How do LPs really think about meaningful ownership?
Right.
And is it first check, or is it across multiple checks that they're really looking at what is meaningful?
Mm-hmm. Yeah, so I think you hit on a couple of really important points there. So I think it's ownership over the life of the startup, number one. So if you're investing early, you might have a smaller amount of ownership, but if you know that because of the pro rata rights that you structured in, and then you can kind of grow that over time. But I think the ownership component is really defined by your core portfolio math and your portfolio construction. So most LPs, this is a bit of a generalization, would prefer concentrated funds, where there is a meaningful amount of diligence that goes in and a meaningful ownership. So to use a specific example, it might be we make 18 investments out of this fund and we're looking for 10 to 15% ownership at the seed stage, with the ability to follow on in subsequent rounds to bring our ownership percentage either up maybe to 15 or 20%, or steady and stable at around 10%, so to speak. So I think that is the kind of traditional LP expectation, but it really comes down to what risk are you taking, and for what potential upside and reward. So if you're at the earliest stages, and you're saying we're really shooting for a 10X fund, then how you construct your portfolio might be a little different. You might make a lot of little bets, but reserve a very meaningful amount, let's say 60% of your fund, for follow-on, because you know that, hey, even if we get 5% in the earliest days, we're going to ask for super pro rata, and we can work our way up to 10% for a relatively small amount of capital, right? As opposed to a Series C fund or Series D fund, which might have to put tens of millions of dollars for just a few percentage points. But of course, it's de-risked. So by the time it's, let's call it lift at the Series C, you're pretty sure that thing's not going to, fall apart in a week. But that certainly might happen at the pre-seed. So I think those are the factors that are at play as LPs are kind of doing this calculus and inside their kind of black box, so to speak.
So that brings me to another question about track record. Most emerging managers don't have that much of a track record, or it's kind of blended into a fund they may have worked at. Some of them who have been active angel investors will be able to show some track record from their angel investments. As far as LPs go, how do they look at, and what does a strong track record of investing mean?
Yeah. So I think, to the extent that you can, that you have written kind of angel checks or invested through a fund, that's great and that's important in getting some level of attribution for those investments. Ideally, that fits along, your thesis. Sometimes that may not be true, but if you can show that you can get into and win, great deals, that's wonderful. The other thing that some folks have done really well is you do something else that shows that you'll be able to get mindshare and access. So First Run Capital has done a phenomenal job with content and community, as an example. There have been other funds that have started basically by building a massive following on social, or they've done it through podcasts, or they've done it through some other mechanism that's allowed them to have founders and LPs know that they're out there and stay top of mind. So there are other ways outside of a pure investing track record to at least help inch your way towards getting that first close for your first fund done. That being said, there's really no substitute for writing real checks, putting real money to work. So you do have to do that in some way, shape, or form. And again, if you're committed to this asset class for 30, 40 years, you might even take an internship just to be able to get close and to start writing some checks to be able to start to build that track record or that awareness or that network or that connectivity into the ecosystem. So I think to just be blunt, there is no substitute for writing real checks and having real skin in the game.
Yeah. Well, brings me to a follow-up question that just popped into my head, which was AngelList has been around for a long time, and the syndicates have been around for a while. And that a lot of people have talked about how syndicates are a great way for people that don't necessarily have a lot of liquid capital to start investing. Of course, you still have to be accredited, at least in the U.S. But has that come up? Have you seen folks that were running an AngelList syndicate, writing $1,000, $2,000, $3,000 checks, have done, I don't know how many deals, 20 deals, 50 deals, and eventually said, hey, I want to raise a fund, and use that as kind of their track record when they went to LPs and said, look, these are the 20 or 50 companies that I invested in through my syndicate. They're small amounts of money, but out of these companies, here are the successes in 2, 3, 4, 5 years. How do LPs look at that? And is that something that is a good substitute for folks that are just getting started and may not have hundreds of thousands of dollars to deploy over in 2 or 3 years into a couple of companies?
Absolutely. And I think, we've seen some recent success stories of that. Zach, who had a very successful, or has a very successful syndicate on AngelList, recently raised a fund. I believe it was $40 million backed by Industry Ventures, if I remember correctly. So, that played out exactly as you just described it. And there are many other examples of that. There's a handful of other folks that have built really impressive syndicates on AngelList. And, now with Republic and Republic Private Markets, there's a handful of platforms that exist. There's other ways to be able to create SPVs relatively quickly. The Assure platform, Flow Inc. There's so many different methods that exist today where you can spin up these SPVs relatively quickly, deploy a little bit of capital, from your own checkbook, and then bring in other VCs. So now's a phenomenal time to be doing that against a sharp thesis if that's something you're passionate about.
Cool. Okay. Good to know. We got another question. If you got a second, let's.
Yeah.
As an early stage VC, how diverse should my asset class of startups, I guess, be before going to an LP or creating an SVP?
Mm-hmm. Yeah. So I think.
So I guess it's really more about like how diversified of a portfolio should I have before I start trying to pitch a fund or an SVP.
Yeah. So I think having a set of different startup or business models or different startups is critical. I think they all should be thesis aligned, so that it's clear that you're I don't think we've talked about this, but I think it might be an important place to do that now. So what are some of these different theses that you can go after? So one of them might be, a thesis built around a particular school. So the House Fund in UC Berkeley, for example, around a particular stage, saying, hey, we invest at the pre-seed like Charles Hudson and precursor ventures, or, we invest, more broadly just across the seed stage, and we look for certain types of business models. So it might be, hey, we're interested in, network effects, for example, or there might be something like we're interested in a particular vertical, like FinDC and FinTech, for example. So these are all different sharp approaches that you can take. So I think having at least, half a dozen investments, or ideally, significantly more than that, maybe a dozen investments in that particular thesis, or combination of those. Kind of, you might be, hey, we invest at the seed stage in fintech companies, in North America. Great, and we see that as a burgeoning market, and there's something there that we need to get behind. So having a dozen odd investments in that thesis is a great way to be able to then go to LPs and say, hey, this is what I'm interested in. The interesting thing about SPVs is that you don't necessarily need, super sharp thesis. Of course, it's better if all of your SPVs are against a specific thesis and in service of something, down the road. But I've seen many folks who are just operators or executives, and they're running SPVs on AngelList on the side, and they're doing that as a way to, just get access, stay sharp, get some great returns. And for them, they may do a fintech investment one day, and they may do a vertical SaaS investment the other, and they may do a consumer mobile local social app the next minute. So there's no rhyme or reason there. That's fine. They're not starting a fund. It's all good. They're doing it for other reasons. So I think just being clear about what your outcome is and why you're doing that is really important. If your goal eventually is to start a fund, you may still do a bunch of random deals and then say, hey, over having done 50 deals, I realized that 10 of them that I did fit this thesis so crisply, and that's where I made a lot of my returns. So that's what I'm going to double down on, and that's where I'm going to start my fund. That's great too.
So, Arjun, in the work that you've been doing at Valence, you're working with a bunch of funds as well. Are you seeing funds focus on specific niche areas, like a particular vertical, like fintech only, or are you seeing other theses kind of come out, right? Like there's been a little bit of a movement over the last couple of years to say, hey, instead of generic funds, LPs want to see focused funds, right? And now I think we're starting to see people move away from focused funds back to more generic funds. Right. So I'm curious what you are seeing with the folks that you're working with and people that you're talking to.
Sure.
Which way is this going, and what are LPs more interested in today?
Yeah, I think the vertical fund is an easier sell for LPs because they can really say, oh, I believe in this market and where it's going. It's not to say that it's easy, but it's easier. The generalist fund is very challenging because you have to say we are building a brand, a set of values, and a legacy, frankly, that will ensure that the best founders, continue to come to us. And we're going to have a plethora of experience and expertise across the fundamentals of company building that will ensure that we continue to see the best deals. That is a much harder story to sell than to say, hey, we're the world's best experts in enterprise SaaS. We know this well. We've invested in 3 unicorn companies. We've got 10 more that are on their way, and we're here we go. Write us a check. That's an easier sell than saying, hey, we're going to go build the next Sequoia or Andreessen or kind of platform that will be generalist for a long time. That being said, I think seeing a few of these pop up for sure. But they're further and fewer than I would definitely. I see a lot more on the vertical kind of fund side than I do on the generalist side.
Mm-hmm. Okay. We got another question here, again from Vikram. What do you think are the emerging theses that have great potential to dive in?
Sure.
Your thoughts on vertical theses that look interesting.
Sure. So a couple that I think are intriguing at this moment, and I think given our current realities kind of in a COVID environment, I think health and wellness more broadly is fascinating. I think there's a handful of funds that are doing that really well. Social Starts and Joyance, for example. I think e-commerce, as it's a pretty broad and at the same time very niche topic, but I think all things impacting, let's call it long tail SMB, might be a better framing for that. And I think there's a handful of larger funds, GGV, NFX, that have kind of more generalist firms that have focused on that area of SMB SaaS, or things like companies like Slice, for example, or Sense in the laundry space. Those sort of companies, those sort of funds are out there. I don't know if that's enough to be a fund specific thesis, but it's certainly let's call it an area of interest at this moment in time. Fintech, for me, has been and remains an area of a lot of interest. And I think how money is moving and changing from ways that we've looked at it for hundreds of years, and how that's shifting today with so many different things going on with insurtech and lendtech and crypto and blockchain and what's going on in kind of the wealth management world and with Robinhood. So there's a lot of tectonic plates that are shifting right now in the world of finance. The other space, again, that's maybe not enough to start a fund around, but is certainly interesting, is let's call it, industry 4.0. And I've seen some, 1 or 2 funds around this more broadly, but this is logistics, shipping, transportation, manufacturing, topics that are covered by, those kind of subsegments more broadly, and anything and everything that affects that, including, construction and the like. So that's another broad space that I think is going to see a lot of turn. And then deep tech remains a phenomenal space. And I think it requires a certain depth of understanding and a certain GP that really understands how to take something that is rooted in very sophisticated science and turn it into something that is monetizable and scalable. That often touches hardware, which makes it even more complicated. But for those funds that have got that right, DCVC comes to mind, NeoTribe, and a few others, they see absolutely phenomenal returns, and they have a massive impact on society, which is super exciting. Those are certainly not for everyone.
Yeah. We got a couple more minutes left. Arjun, I'd like to take this 5-7 minutes that we've got left. Ask you one more question, and if the audience has other questions, please feel free to throw them in the comments. Try to answer them before we log off. But a follow-up question to Vikram's question that I have is, besides for the specific verticals that you mentioned, are there specific geographies that you personally have found very intriguing, right? Like, that at 500, that's a lot of what we did was like very geographically diverse portfolio. What kind of impact has that had on your thoughts as an angel investor? And is that an area that also interests you, and specifically what areas?
Yeah.
So geographies, I should say.
Yeah, I think being at 500 gave me and us, I think, an incredible purview into what's happening in innovation, more broadly across the world. And so the ecosystems that I was fortunate to spend a little bit of time. South America is fascinating. There's so much going on in Mexico City, Brazil, Argentina. I'm probably, Colombia is phenomenal. There's a lot of interesting action there. Mexico City seems to be the nexus where a lot of that action is kind of distilled, in my experience at least. So excited and bullish about that. And then, Paris, and I think what's happening in France, particularly with AI and the corridor to Montreal and Toronto and some of the really sophisticated and deep AI that's coming out of there, has been really interesting to watch. In the Middle East, I've seen some phenomenal things with, again, shipping, logistics, transportation, and particularly, out of Dubai, and all the things moving, through the Emirates, so to speak. But also, I've seen some interesting, action from Oman and Bahrain and Saudi. And then in Asia, I think Southeast Asia for me has been a fascinating ecosystem to watch. Indonesia, Thailand, Vietnam. There have been some fascinating really hyper growth businesses come out of that region, which has been great. And of course, the big elephants in the room, China and India, they're very much unique ecosystems that require all of those require obviously being on the ground and really deeply understanding. But those two in particular have their own nuances to them, but also obviously a tremendous amount of growth. So yeah, I think sitting in Silicon Valley, sitting here in San Francisco, I think my preference is to work with founders that come from all over the world that might be leveraging geographic arbitrage in really sophisticated ways, but are physically, in and around generally, this area, or adopt the mindset of what it means to build a hyper growth. And Silicon Valley, I use that term, broadly to mean the philosophy, not the place, but embody that level of kind of hyper growth. So we've, worked with some really awesome companies that have a ton of folks in Ireland, but have a deep, connectivity here in Silicon Valley and are growing at what's called Silicon Valley cadence. Yeah, I'm long-term bullish on all of these regions across the world, with a 10 to, in some cases, 20-year time horizon. But there is a lot to be done that is appropriately localized, and there's a lot that's happening already with companies that are international, that are outside of the Silicon Valley ecosystem, that are building globally and seeing global success, from their respective regions. Early days, but it's exciting that that's possible.
Cool. We got one more question if you're up for it. And then I want to ask you if you'd like to plug Valence and how people can perhaps work with Valence and get in touch with you. So one more question. Ashutosh asks, what are some tips that you would suggest founders use for building relationships, given that a lot of in-person networking has been put on hold?
Yeah, it's certainly challenging right now, and I think hearing this a lot out in the ecosystem. I think going back to kind of newsletters and sharing, so for your warmer networks, or let's call it folks that you're already plugged into, producing content, producing things that are newsletters, insights, blogs that can be consumed on folks' own time, but that showcase what you're up to in the ecosystem, I think is a great way to stay engaged. I was just talking with a general partner at a large venture fund yesterday, and he says, hey, he's really gotten into podcasts and videos and live during this time because
Is he watching today?
I hope so. But he just can't watch another Netflix show or watch something else on Amazon. It's like, I need something else that's intellectually stimulating or that way. So I think there is a huge demand for content of that variety, whether it's blog posts or video or podcasts. And then also I think there's the ability to do very quick phone calls. I think there's a ton of Zoom fatigue out in the ecosystem. So if you just talk to someone and say, hey, let's do a virtual walk and talk, or let's do a virtual walking one-on-one, and we can each go for a walk in our respective areas and just catch up, you might get a better reception than, hey, can we get on a Zoom call for another hour? I think what I'm hearing, there's just a ton of Zoom fatigue out in the ecosystem. So, using the phone or text or even, voice messages on WhatsApp or Signal or something like that might be a helpful way to build relationships without, having yet another video call on the books for someone. And this is more of a light touch way. Of course, there's appropriate times to dig in and have a very robust, context-rich video conversation. But sometimes if you want to make it light touch and easy, look for other avenues to engage with folks.
One of the things that I have also suggested to founders is take the idea of doing the investor updates and kind of broaden that out. Right. Like just say, all right, let's do something on a more regular basis, something that might be weekly, something monthly for some companies, but reach out to a broader audience and perhaps share things that are not necessarily things that you want to keep private, but tell them what's going on with the product, tell them what's going on with the company, and that you're available. You'd love to catch up with people. And that's worked for some of the founders that I know have tried it. They've increased the frequency of sending out their updates. They've broadened out who they're sending those updates to, and that's resulted in better conversations with even customers in some cases. So
for sure,
I think that's also something that's helpful.
Strong second to that.
Yeah.
Arjun, we did that at ReTargeter back in the day. We used to send a monthly email to everybody in our broader ecosystem, investors and customers and friends of the business, and found that to be really, really impactful. So that's a great point, and I just want to second that strongly. Yeah.
Cool. Real quick, tell us about Valence and how people could perhaps work with you guys and how to reach out to you.
Yeah, thank you. So Valence is an advisory entity. John Lau, my partner, is a very seasoned executive coach and a phenomenal communicator and writer, and deeply understands kind of the depths of executive coaching and communications. So the two of us work together to support founders in kind of a weekly coaching cadence where both of us are on the call. And that's how, we support the founders that we work with. On the fund side, we support funds either in the emerging side when they're just getting going, or in some rare cases, we'll support funds that are emerged and much further along as they think about different aspects of their fund journey. Those are typically folks we've known already for a while, but in some cases we'll be open to new fund managers there. And we work with people that are in our extended network. So, you can reach out to us on LinkedIn, on Twitter, or, the best way in is through a warm introduction.
Fantastic. Arjun, thank you so much for doing this.
Thank you for having me.
I sure learned a lot. Hopefully we'll be able to do another one at some point and talk about your journey as an entrepreneur as an investor. Again, thanks a lot. A lot of fun. And if anyone would like to reach out to Arjun, you know how to do it. Try to get a warm intro from somebody. And we'll see you again next time. I think next week we're going to do a special conversation with somebody that I'm still trying to finalize, but you will see stuff on social media about that, hopefully in the next couple of days.
Great.
Thanks again for joining me, everyone. I will see you again next time. Thanks, Arjun.
Thank you, Pankaj. Yeah, Vikram, you have permission. Go for it.
Yeah.